So, welcome to the most interesting and most difficult, most conceptual part of the economics, and that is the financial market, under which we will discuss the money market as well as the capital market. In capital market, we will discuss about the share market, how the share market functions, what are the terminologies which are related to the share market. We can say NSE is going up, NSE is going down. What exactly NSE means, and what is the indices to measure NSE. Then we discuss what is BSC, the Sensex, then some international examples we'll discuss. Then we'll discuss few definitions. What is futures, what is options, what is stag, arbitrage, bull, BL, all these small things we are going to discuss in today's lecture. I want your 100% concentration for today's lecture. So, first of all, what is the need of a financial market? We discussed there are different types of banks. There are the banking institutions, then we have the NBFCs, the microfinance institutions, then the marketing committees. All different institutions are there. How they are interrelated to each other? What is the role of the money lender? How I think in one of the lectures we discussed about, there is a huge vacuum which has been created in between the scheduled commercial banks and the money lenders, and this vacuum has been filled up by the maybe the NBFCs, or recently RBI gave license to the primary banks, small banks, and all these things. So this is how these financial market is in between the total financial landscape. First of all, the money flows. Suppose for the flow of the money from this direction to this direction, suppose the money wants to flow like this, it should be this person should be having some surplus amount of money, and this person should be have some deficit amount of money. Then only the money will flow from this direction to this direction. So this is how the money always flows from the surplus capital towards the scarce capital. And here comes, just like we have OLX. So what is OLX? The role of OLX is somebody wants to sell and somebody wants to purchase. OLX provides an platform, an intermediate platform, over which somebody will come and say I want to sell this, somebody will come and this he or she can say I want to purchase this. The same thing is nothing but the financial market. The financial market provides that platform. So this is the lender and this is the borrower. The lenders can be individual, the companies, even the banks, and the borrowers can be individual, can also borrow, the companies can also borrow, the government can also borrow, different other financial institutions are there. But in between we have two things. First one is the financial intermediaries that we discussed in the last chapter. The banks, they behave like the financial intermediaries. Financial intermediaries means nothing. They will borrow from somebody and they will lend to somebody. That is what the role of the financial intermediaries. Then the banks are the classic example of financial intermediaries. Then insurance companies also, they take the premium, then they will invest somewhere. From that investing, somebody can take a loan. So we have the banks, the insurance companies and all, they are the example of financial intermediaries. Then we have the financial market, the today's lecture. What is the role of financial market? The financial market is nothing but they can be stock exchanges. So over the stock exchange, somebody can invest, and these companies are also listed here. So we will invest in the company. In the first lecture we will discuss, if you want to start your own company, how can you start your own company? Your own money or promoters money should be there. Then there is you can take a loan, that is known as debt, and whatever remaining other funds you want to borrow, you can dilute the ownership. You can say I want to sell this much amount of share, and this share is nothing but a certain percentage of the ownership. So one share can be, suppose one share is there, so one share can be equals to 0.0001% of the ownership. So if you have purchased 5 shares, it means you have 0.0005% ownership of this company. So you can dilute the ownership, and in return, if I am purchasing the ownership, if I am becoming the owner of this company, then I will have to pay something. So this is also a mechanism through which this company can arrange some funds. And what is the institution that provides this type of business? There should be some mechanism, some institution which provides this business. So this type of business is being provided by the stock exchanges. Then there are some money market. So money market we will discuss. The very next topic is the money market, and then we can have some other intermediaries, just like the foreign exchanges. So stock exchange, money market, foreign exchanges, all these are the examples of the financial market. So this is what the chain is. This is how the economy performs. The lenders are there, the borrowers are there, and these are the in between. Financial intermediaries are there as well as the financial markets are there. Then we have, what is the definition of financial market? So financial market is nothing but it includes financial institutions. Financial institutions means we can have banks there, we can have stock exchanges there, we can have the money market there. So all these are the financial institutions. So financial market includes financial institutions, plus it includes financial instruments. Financial instruments means we can have shares, we can have preference shares, we can have bonds, or we can say debentures, we can have T-bills, we can have government dated securities. So all these we have already discussed in the chapter of securities. Under that securities we discuss bonds, under which we discuss bond issued by government, bond issued by bank, and bond issued by the private corporates. Second one we discuss about the equities or shares, then we discuss normal shares as well as the preference shares. So all these they are the classic example of financial instruments. And then as well as the regulators. Regulators means we have SEBI, we have RBI, all these are the financial regulators. So the agglomeration, the addition of all these things is known as the financial market. So financial market is a huge concept. It includes all these entities. It means financial institutions, financial instruments, as well as the financial market. So financial market, financial regulator. Financial market is divided into money market as well as capital market. So first I will try to discuss the difference, but you may not be able to appreciate the difference unless and until I discuss each and every instrument. These are the markets. Then we have different instruments, like we have commercial paper, we have certificate of deposit. Just these are the examples of the money market. Then we can have under capital market also we have IPO, FPO, rights issue, and all these things. So first what you have to do is, first I'm going to discuss this thing, but maybe 50 or 60% of you will not be able to appreciate it. So first try to cram something out of it, then we will discuss about these things, and then please go back to the starting of the lecture and again try to get the difference between these things. You can expect a question over these differences, that money market is a long time, it is for the short duration or it is for the long duration. Then they can ask the examples. These are the examples of money market instrument, these are the examples of capital market instruments. So first I will try to discuss this thing. So money market is nothing but, first of all, is there is no watertight compartment, there is no watertight difference between money market and the capital market. These are the broad differences which we are going to discuss. So money market is nothing but it is for the short term. If somebody wants to invest, whatever the financial relationship between these two entities, this is for the short term. Short term in economics means it is for the less than 1 year. In case of capital market, it is for the medium term. Medium means 1 to 5 years, and long term means more than 5 years. So money market is a short term and capital market is for the medium and the long term. Then the purpose of the money market, it is a source of working capital finance of the firms. It means, suppose one firm is there, working capital finance means for the day-to-day business, if you need some money, you can borrow for two different purposes. First, you can borrow because you want to expand the business. Business expansion you want to do, that is why you are borrowing. And the second thing is, if your expenditure is more, for day-to-day working finance expenditure you need some money, then that is what the second purpose is. Suppose you want to recruit 10 more people. So to recruit 10 more people you need some money, and suppose you borrowed for this salary of these 10 new employees. So that will be come under the source of the working capital finance. This is the working capital finance. And capital market, it deals with financing the capital assets. Suppose you want to purchase something, just like recently the government allowed to purchase the Howitzer. So these are the capital assets. If you want to expand the business, if you want to invest in some capital assets, so that market is known as the capital market. So the money market is the source. What is the purpose of money market? It acts as a source of the working capital finance of the companies. And what is the source of the capital market? It is a source of financing the capital assets. So what instrument is being used? So depending on that, it will be regarded as money market or the capital market. Suppose this company wants to do the business expansion and this company diluted the ownership. So this dilution of ownership is a tool that is known as equities, IPOs and FPOs. Maybe you will not be able to appreciate these things now, but once we will discuss all these things, then please come back to the differences and try to understand the differences. And then we have the money market deals only in debt. It means only this options. We discuss how to start a company. You can take a loan, that is known as debt. So deals only it debt instruments, and the duration of that debt should be less than 1 year because it is for the short term. And the capital market, it deals in debt as well as equities. It means it includes this also, and this means for more than 1 year if you have. National Savings Certificate, Kisan Vikas Patra, all these things are nothing but debt only. Kisan Vikas Patra is a type of loan taken by the government from us. This is what the Kisan Vikas Patra is. Under Kisan Vikas Patra it is written, please deposit this much amount of money, we will double your money in 100 months. So in other words, it means I have given a loan to the government, and in return government has given some receipt to me, and that receipt is nothing but the Kisan Vikas Patra. So the capital market deals with both. It deals with the debt as well as it deals with the equity instruments. Then we have what are the examples, what are the tools in this money market instruments. So first one is certificate on deposit. In detail we will discuss here on. Then we have the commercial paper. Then we have the T-bills. T-bills we already discussed under the securities. T-bills is nothing but the treasury bills which are issued by the government for less than 1 year, and T-bills are issued for 4 maturity periods. This also we discussed, 14 days, 91 days, 182 days and 364 days. And this T-bills, they are issued by union government only. They cannot be issued by the state government. Then RBI, on the behalf of the government of India, RBI issues this to the primary dealers. All these things we have already discussed in the previous lectures. Then we have in case of capital market, the examples are shares, government dated securities and all. Then the money market, it deals only in the high value transactions, not deal in 1000 rupees, 2000 rupees, 5000 rupees. But the capital market, it deals in all value transactions, just like shares. In case of shares, you can purchase even shares worth rupees 500. I can purchase 500 rupees share, maybe any company. But in case of this money market, for example, if you will taking this T-bills, so it can be 1 lakh rupees. In case of certificate of deposit, this commercial paper, all these they have some minimum criteria that we will discuss later on. So this is what we have, the major differences between the money market as well as the capital market instruments. Then next we will discuss about the money market. Individually we will discuss So the money market is further divided into organized and unorganized. Under organized we have Reserve Bank of India, under organized we have some of the NBFCs, under organized we have the commercial banks, but under unorganized we have the local banks, and then we have these hundis and all these things. So these commercial paper, certificate of deposit, call money, T-bills and all this comes under this organized money market. Individually we will discuss. So under organized, the first one is the commercial paper. So the major characteristic of the commercial paper, it is these are the issuer who can issue this particular commercial paper. So the companies, the individual company can issue. Then we can have the financial institutions. Not all financial institutions, but they have to take permission from the RBI. So financial institutions, they can purchase it. Then we have the primary dealers. They can also issue this particular commercial paper. And who can invest? Who can buy this on this commercial paper? The individuals can buy, the banks can buy, the companies can buy. So all these entities, they can issue and they can invest. So these are like, they are the money market, whatever the different instruments of the money market, they are highly liquid entities. And what is the definition of liquidity? Easily tradable. So this commercial paper is easily tradable. So when this company or these, they will issue this commercial paper, so they are going to purchase it. And what will be written in this commercial paper? It will be written, please give me 100 rupees, I'll give you maybe 105 rupees or 107 rupees, 7% interest rate, 5% interest rate. This is what the relationship will be like. But they are not secured, they are just the promissory notes. It means when these issuers, they will issue this commercial paper, there will not be any mortgage. No security will be there, nothing, no collateral is there. So it is just the credit worthiness of this company or financial institutions or primary dealer. On the basis of this credit worthiness only, these investors, they are purchasing this commercial paper. So they are not secured, it means they are only the promissory notes. Then we have, they are issued at discount. Issued at discount means, suppose this commercial paper is of 100 rupees and the rate of interest is 5%. So ideally what it should be? It should be this individual should purchase it, this commercial paper worth rupees 100. On this 100, and maybe after 1 year, this investor should return 105 rupees. This should be ideally done. The face value of this commercial paper is 100 rupees because it is written 100 rupees worth commercial paper which I want to sell to somebody and I will pay 5% interest rate. So this is what we have. The thing is, they are issued at discount. It should be vice versa. These individuals, they should pay 100 rupees and in return, this issuer should return 105 rupees maybe after 1 year if 5% is the interest rate. But the thing is, in case of commercial paper, they are issued at discount. Issued at discount means whatever the interest, it means 5 rupees. So 5 rupees will be deducted while giving the principal. It means rather than paying 100 rupees, they will only pay 95 rupees. And after 1 year, company will pay 100 rupees. Although it is on this 100 rupees, these individual, this company, financial institutions, primary dealers, they want 100 rupees, but the commercial paper, they are issued at discount, which means the interest will be deducted, whatever the interest, it will be deducted from the principal only. So these investors, they will deduct the interest, that is 5 rupees from the principal amount, and they will pay only 95 rupees. After 1 year, these issuers, they will return 100 rupees to the investor. This is what it means, they are issued discount to the face value. Then the next point is, it is the minimum. When you are issuing this commercial paper, the minimum amount is 5 lakh rupees. So the value of this commercial paper is 5 lakhs. Then in multiples of 5 lakhs only, it means 5 lakhs, 10, 15, 20, 25, 30. Earlier it was, the minimum value was 25 lakh rupees, but the present value is 5 lakh rupees. So commercial paper is issued for a minimum value of 5 lakh rupees and then in multiples of 5 lakh rupees only. The next one is, this commercial paper is tradable. Commercial paper is tradable means, suppose you have issued this commercial paper and individual 1 has purchased it. So this individual 1 can sell it to individual 2. Individual 2 can sell to individual 3. Individual 3 can sell to this new company. This company can sell to one of the banks. So all these are nothing but it means tradable. So commercial paper, they are tradable. Then we have then some small new things are there. It was started in 1990s. Then the rating of this commercial paper is must, because as an investor, suppose individual is the investor, so individual might not be having the knowledge, so there should be some rating agency, we should rate that particular commercial paper, like it is AAA, AA, whatever the rating agency is. So depending on that rating agency, CRISIL is there, ICRA is there, then we have Moody's, Fitch and all they are there. So different rating agencies, they can rate the commercial paper different ratings. One rating agency can give it AAA, the second can give it AA. So it depends on the rating agency, but rating is must. So this is commercial paper, it shows the relationship between this and this. Similarly, we have a certificate of deposit. So certificate of deposit is, it is being issued by the scheduled commercial banks except RRBs. And who is going to invest in this? Who is investing in certificate of deposit? These can be individuals. Suppose whoever, a company can be there. So certificate of deposit means these companies or individuals so certificate of deposit is very much similar to FD. In case of fixed deposit also, these companies, individuals, they will invest their money in the scheduled commercial banks, and in return the scheduled commercial banks will issue fixed deposit. But here also it is companies, individuals are investing something, and in return the scheduled commercial banks, or we can say the financial institutions, they are issuing the certificate of, not all financial institutions, but who has taken the license from RBI, they will issue certificate of deposit. But what is the difference? The difference is, in case of FD and in case of certificate of deposit, certificate of deposit, they are tradable. We discussed under FD, they are not tradable. Whoever is got the FD, suppose I have opened an FD account in some bank, HDFC. So only I can able to mature this FD, nobody else. Or suppose my nominee is there, but I cannot sell this FD to you. It means FDs are not tradable, as well as FDs are not negotiable. We cannot go to the bank, enter the bank branch, and we can say I have 5 crore rupees, but and I want to invest in fixed deposit, but I want 10% interest rate rather than 9% interest rate. So the interest rate, it is being decided by the banks in case of fixed deposit. So FDs are not negotiable. And then the next one of certificate of deposit, they are issued at discount to the face value. Suppose you want to open an FD account of 1000 rupees and your interest will be 100 rupees, for example. So it's not like you will give 900 rupees and after 6 months or 1 year the bank will give you 1000 rupees. No, you will give 1000 rupees, after 1 year the bank will give you 1100 rupees. But that is not the case in case of certificate of deposit. Just like commercial paper also, in case of certificate of deposits, if this certificate of deposit is of 1000 rupees and the interest amount is 100 rupees, so in this case you will give only 900 rupees. This investor will give only 900 rupees, and this scheduled commercial banks, they will return 1000 rupees after 1 year. So the same way it is, they are issued at discount. but the minimum value in this is 1 lakh, and then in multiples of 1 lakh only. So this is what the certificate of deposit is. So they are very much similar to FD, but these are the three differences. CDs are tradable, negotiable, as well as they are issued at discount. Then we have the call money. Call money is highly efficient thing. Suppose one bank is there, SBI, and SBI needs some funds. So there are multiple alternatives which are available to SBI. SBI can take from RBI. So this is one mechanism. SBI can increase the FD rate, and A, B, C, they will invest in SBI. SBI can also take a loan by issuing the bonds or debentures. So this is also one of the mechanism. Then we have the certificate of deposit is also one mechanism. SBI can issue certificate of deposit. So these are some mechanism. One more mechanism is known as call money. Under this call money, what SBI will say? SBI will say, I need 100 rupees, and different financial entities, which majorly includes banks also. Suppose ICICI is there, we can say PNB is there, we can say Bank of Baroda is there, and Dena Bank is there. It is very much possible that some of these banks, they have excess money for maybe one night. Different maturities are there in case of call money. 4 maturity periods are there. It is for one night. First one, it is for less than 3 months. 3 days, 1 month, and 3 months. So this call money instruments, they are for the 4 maturity periods, but the maximum maturity is 3 months, 1 night, 3 days, 1 month, and 3 months. So suppose this ICICI is having some excess money, maybe for 3 days, 2 days, or 1 night. So they cannot give a loan. PNB also is having some extra money, they cannot give a loan. So this is one of the alternative. Suppose ICICI is having 100 extra rupees. So there are two options. Either SBI wants it, or ICICI is having the excess supply. So if SBI wants it, SBI will say, I need 100 rupees at the rate of 8%. No, ICICI can offer, I have 100 rupees for 1 night or 3 days or whatever amount duration is, but I want 9% interest rate. Now PNB can also have some excess funds. So PNB can say, I have 100 rupees, but I want 8.8%. Bank of Baroda will say, I want 9.1%. Dena Bank will say, here I want 8.5%. वैसे Dena Bank में कुछ नहीं आता. So Dena Bank will say, I want 8.5%. In 8.5%, I can give you 100 rupees loan. So this the rate at which these banks are offering is known as Mumbai Interbank Offer Rate. This is the offer rate, and the rate at which the final bid is happening, that is known as the my bid. Now SBI will take a loan from whom? So SBI will take a loan from Dena Bank, because Dena Bank is offering the loan at minimum interest rate. So this is what the call money market is. In case of call money market, banks will borrow from other financial institutions or the other banks. So 80% of this market is not under banks. It is under the other financial institutions, because banks have the option, a number of things are there, but 80% of the market of this call money, these providers, not the buyers. Here we can have a lot of banks, but these providers, 80% are other financial institutions. So this is known as the call money. And we have this my bor and my bid concept. These are nothing but that we have borrowed from LIBOR, London Interbank Offer Rate, and London Interbank Bid Rate. So across the world GDP that we have, that 60 trillion GDP that we have, so this 60 trillion GDP needs some funds. So these GDP, when all this economy, they need some funds, that creates the demand of money. Similarly, a number of financial institutions are there. which are the source of supply of this money. So this source as well as destinations, LIBOR and LIBID, they optimally find out the value of the total demand and total supply. Accordingly, they will fix this LIBOR and LIBID, London Interbank Offer Rate and London Interbank Bid Rate. All small institutions of the world, just like we have in case of India, we have RBI, but with respect to this international GDP, the value of RBI is very small, or the value of this MIBOR, MIBID and all this interest rate, it is very small. So somewhere this MIBOR is deriving its value somewhere from this LIBOR. So LIBOR acts as a benchmark. Depending on the value of the LIBOR, all other different rates are being decided. You know, the relationship is like the rate at which you are getting the house loan is somewhere connected to the value of the LIBOR or the LIBID. So all these international entities, they are related. Then we have the trade bills, T-bills. T-bills we already discussed, treasury bills, government less than 1 year, 4 maturity periods and all. No need to waste the time. The next one is the trade bills. Trade bills we also discussed. Suppose two firms are there, A and B. Under that monetary policy, we discussed the bank rate. So two entities A and B are there. B sold a raw material of 1 lakh rupees, and in return A gave a piece of paper on which it is written, you sold a raw material of 1 lakh rupees, I will return 1,10,000 rupees, 1,03,000 rupees, 5,000 rupees after 3 months. So this piece of paper is known as trade bill. At that time we discussed that is known as commercial bill. Why we discussed it is known as commercial bill? Because the next step, if this T bill is being accepted or purchased by the bank, in that example PNB has purchased that T bill because B wants to decrease the risk, because the duration of this trade bill is 3 months. After 3 months A will return 1,05,000 rupees to B. But suppose within these 3 months if A files bankruptcy, if the company A shut down, then that will be the 1,05,000 rupees loss of B. So B wants to decrease the risk. How B can decrease the risk? B can sell this T bill or trade bill to the commercial bank at some discount. It means the value of this T bill is 1.05 lakh, but maybe PNB is purchasing in 1 lakh rupees. So it is being issued at a discount of 5,000 rupees. So PNB will instantly repay 1 lakh rupees to B, and after 3 months this A will pay 1,05,000 rupees to PNB rather than to B. So this is the trade bill. If these trade bills, they are being accepted by the banks. When they are accepted by the banks, then that is known as the commercial bill. Then we have, under the unorganized market, we have hundis. In case of hundis, hundis are for the informal sector. Small companies are there, and these small companies are doing the business with the help of hundis. Hundis are also, they can also be very much similar to trade bills and commercial bills, but hundis are not accepted by the banks. Then hundis are also further divided into darshan hundi, mudati hundi, not much relevant from exam perspective. So this is what the money market that we have. Then the second one we have is the capital market. So under capital market, we have gilt-edged securities. Then we have the corporates securities, and then we have the others. In others we have the venture capital fund, angel investor, merchant banks and all this. So this is what the structure of the capital market. Gilt-edged security means nothing but the government securities. Why they are regarded as gilt-edged? Because they are highly liquid. Everybody will accept it, and there is no risk associated with the government securities, because anytime the government can print the currency and can repay whatever the debt the government was in. So gilt-edged security is nothing but the government dated security. The maturity period is for more than 1 year. And why they are regarded as gilt-edged? Because they are the first class they are the highly liquid securities and there is no risk associated with this gilt edge securities. The second we will discuss this others, and then later we will discuss about this corporate securities. First we will discuss the primary market and the secondary market. So before that is venture capital fund. So a lot of venture capital fund nowadays are coming. So venture capital fund is nothing but they are investing your new innovative ideas. For example, a small startup is there. So a small startup is there having a brilliant idea, but this promoter don't have any money. Me and you, we can start a new startup, not a problem, with some innovative idea just like super profs. So super profs is an excellent idea of online classes, but suppose whoever is the owner of super profs don't have enough money. Because to start the super prof, suppose you need 100 crore rupees. So you need some funding. So from where you can get the funds? The first option is your own money. I don't have 100 crore rupees, very poor faculty. The second one is you can take a loan. To take loan, you need some mortgage, some assets are required. I don't have any mortgage or asset. The only option is you have to dilute the ownership. But even if you want to dilute the ownership, who is going to purchase it? Because to start super profs at the very start time only you need some funds. Now of course, maybe after 3 years, 4 years down the line, when the super profs has already started and it's a kind of well-known institutions and online coachings. So maybe now the people have some trust over super profs. But when super profs started, when we started at that time, that this total market was new and we were new to the market. So even though we wanted to sell the securities, we want to dilute the ownership, there was no purchaser in the public. So at that time we went to only a special type of institution that is known as venture capital fund. So this venture capital fund, they listen to all these ideas. This is our new idea and all this thing. And if they are really happy, if they think that this idea is viable, they provided some funds. So this is what the role of the venture capital funds. They invest in the innovative ideas, and in return what they get? They get certain percentage of the equities. So they get some ownership of this particular company. This is what the venture capital fund is. And venture capital fund, they are usually sector specific. For example, Infosys venture capital fund is for the IT sector. Reliance venture capital fund, SIDBI venture capital fund. So different venture capital funds are there. Usually they are sector specific. Then we have the angel investor. What the angel investor means? Venture capital fund is an institution to invest these ideas. An angel investor is an individual. Suppose your relative is there, one of your uncle having millions and millions of rupees. So maybe your uncle can invest in your project. So that is known as the angel investor. An angel investor gives you the seed money, the minimum money that is required to start the business. So in economics that is known as seed money. Then we have the merchant banks. So what is the role of the merchant banks is then when we will discuss how the IPO is being launched. So next, the third one is the corporate securities. So under corporate securities we have two types of market, primary market as well as the secondary market. In case of primary market, it is also known as new issues market, because the new shares are coming in the market. So this provides the platform for the new issues market. It is known as the old issues market. In this, the relationship is between firm and investor. In this case, the relationship is between the investor and investor. How it is like? Suppose for the first time the company wants to dilute the ownership. Recently, CL, Career Launchers, is saying that we will come up with an IPO. It means for the first time they are diluting the ownership. So when for the first time that ownership is being diluted, the relationship is between this entity or firm and the investor. This is investor 1, this is 2, this is 3. So this is what the relationship. But once an IPO has launched, now they will be listed in the share market, NSE or BSE, whichever share market they have listed. So now the relationship in case of secondary market is between investor and investor once it is launched. But suppose today I think that the shares of Infosys most probably will go up, the shares of ONGC will go up, and you think the shares of ONGC will go down. So now the relationship is between us. I will sell it and you will purchase it, or vice versa. So once it is being issued, in case of secondary market, the relationship is between the investor and the investor. Then we have in this case it is for the first time shares are being sold. And in this case already existing shares they are bought and sold. Then we have in case of primary market, who fixes the price? The price is being fixed, price fixed by firm. And in case of secondary market, who fixes the price? It is totally the market. It means demand and supply determines the price. If there is more demand, the prices will go up. If there is less demand, the prices will go down. Then what is the means? Before means, it is a source of work, source of raising capital. A company needs some funds, so they will get to primary market. But once the shares they have been already in the market, once a company has come up with an IPO or FPO, so next time the company will not get anything, only these investors they will get anything. Whatever, if I am there, you are there, so A entity is there, B entity is there, so if I am in profit, so my profit is at the cost of your loss, or vice versa. But for the first time when the company comes up in the primary market, it gives some funds to the firms. You are giving some funds to the company only. So this is what in case of primary market, it is the source of raising capital by the firms. And in case of secondary market, it only provides the liquidity to the existing shares. And then the means sorry, in case of primary market, the means is IPO and FPO, initial public offer, follow on public offer, also known as further public offer. We will discuss later on. So these are the means through which you will get it. And in case of secondary market, the means means the process through which we have ands and means. Finally you want to become an IAS, so this is an and. Means you want to take which classes, you want to attend offline classes, you want to attend the online classes. In case of offline classes, traveling time will be there, you have to go to the institute, and then you have maybe 20 minutes 30 minutes before you have to reach there, and all of things are there. In case of online classes, whenever you are traveling, you can open your tab, open your phone and all these things, you can utilize that particular time. So there are positives, but in case of online classes, no direct one-to-one communication is not there, two-way communication is not there. Right now I am discussing something, and maybe when you will try to listen to this lecture, whatever doubts you will have, so you will ask those doubts, but those doubts are not the real time. So real time two-way communication is the major problem of online classes. But in case of offline classes, you can ask your doubts at the real time. So there are positives and negatives of this thing, but this is the means. The coaching institutes are the means through which you will achieve your goal of becoming IAS or whatever competitive exam you want to clear. In this case, in case of secondary market, the means is this. Stock exchanges provides you the platform. It provides the platform through which you can do the secondary market. So these are what the differences between the primary market and the secondary market. Then we will discuss the issues. I think the lecture is becoming a bit bigger, so I want to just take a 2 minutes break, and we will discuss the second part of the lecture just after 2 minutes. And once the second lecture, the part 2 of the financial market will start, we will start discussing with the issues. Thanks a lot.